Meanwhile, ratings agency Moody's has cut the credit ratings of multiple small and mid-sized US banks. As many as 10 banks now, to be precise, have got this cut in ratings by Moody's. It has also put 6 big lenders on a reviews list. As far as Moody's is concerned, this is not where the action ends. There is perhaps more. There is a warning of more downgrades. Also, Moody's has changed its outlook to negative for 11 major lenders in the US. Now, the ratings agency has cited these recession fears in the US, also a tightening of the monetary policy as the key drivers for the kind of downgrades that they've brought on. Remember, the banking sector in the United States has been going through a tumultuous time since the collapse of Silicon Valley and Signature Bank earlier this year. So now the question is, how will this downgrade impact the sector, the banking sector further? And how fair is it for the markets to react the way they are? Let's discuss this. And for that, Anurag Singh, Managing Partner at Ansid Capital, with us on India Development Debate. Anurag, always good to get your perspective in. Do tell us now, as far as these downgrades, the latest ones that we're talking about. After Fitch has downgraded US credit ratings, now it's about Moody's and the kind of cut that we are seeing on their banking outlook. Some of these banks, do tell us about how significant it is and the kind of impact that's playing out on Wall Street.
So, Vikram, while Fitch was on the government debt, this one is for the regional banks specifically, and so that's the slight nuance. But otherwise, Vikram, again, like rating agencies, they come and they have a strong signaling value. They don't tell us anything that we don't know, but I think they are clearly highlighting the risks that exist in the financial system. And I think, it brings those old memories of 2008. Whenever there are risks in the financial systems, markets really take it as a bad news. So currently, Vikram, what they're saying is that these, so first of all, Federal Reserve has proposed the new regulations for the banks. Earlier, the banks which were, below 250 billion of assets, which is most regional banks, they were given some lighter regulations versus the big fours, which are too big to fail, which is JP Morgan, Citi, Wells Fargo, and Bank of America. Now they're saying even the banks, anybody above 100 billion will have kind of uniform regulations, which puts all the regional banks, one, at a higher cost and, lower profitability eventually for future. The regulations will come effective by 2027. But then the whole point is, Vikram, that they also highlight that there are risks within regional banks on commercial real estate. The delinquencies have doubled in the last since 2022. Delinquencies on commercial real estate and commercial properties has increased. And I think that poses the eventual risk and the downward pressure on these banks, Vikram. So that's the kind of the overall picture.
So already we've seen certain banks already see that kind of downfall. Are we expecting more, Anurag?
No, of course, Vikram. I think I've always believed that, and look, we know that the federal rate hike works with a lag, right? And that's the famous thing that Powell also keeps repeating, that it works with a long and variable lag. So one is there is a lag, which is 6 months to 1 year in normal case. So which is that if they have gone to 5.25%, probably the reverberations will be felt even going into next year. Second is it's variable. So we don't know how much the rate hike will impact in what sections. And this is something that we saw in the March month where Silicon Valley and some of the other regional banks failed. So again, the market fears that there will be a credit event, and that's not good for anyone, right? Because then if the credit event halts the credit for the entire system, almost every company gets impacted, right? So I think, Vikram, there is a sense, and I also believe that probably regulators are over tightening, not on the rates I support, but I think on the banking regulations, the business is gradually moving outside to the shadow banking system. You'll be surprised to know that 80% of the mortgages, which is the home loans in US, actually come outside of the banking system, which itself is a problem issue, right? So ultimately, I think those are the risks, Vikram, that persist. It can certainly go better from there. I'm not making a prediction that it will, but that's what is making the markets nervous, Vikram.
Get this kind of over tightening, like you're calling it, as far as interest rates are concerned. You're saying you're all right with them, But if you're going to have that, and that was considered the trigger, the stimulus as well, and then if these recessionary concerns that have been highlighted, those actually hold true, then how deep an impact are we looking at? Can there be a contagion that would be hard for the authorities to control?
So good part for this economy, Vikram, has been that, and that is probably the hope why the markets were going so strong. They were not running on earnings rise. Recall that the earnings are actually 9% lower compared to 2022. But the markets were trying to get back to almost the all-time highs, which they made in 2021. It was not a hope of earning. It was the hope of the resilient, strong economy, which just kind of fails to cool down, right? So markets thought that there'll be a soft landing and economy can kind of absorb this rate hike. The hope still stays, but ultimately, Vikram, there is no playbook for this because this happened the last time about 40 years back. So when Fed, raised the rates this high. I mean, nobody really knows what will eventually, and the 40-year-old economy was very different then and it is very different now. So we don't know how it will play out, Vikram, but one thing is sure, and that this is something we discussed the last time. Markets need triggers to run ahead or a clear runway. Now, triggers come in the form of earnings or, some of the other revenue growth and those numbers. Those numbers have been falling compared to 2021. So that's clearly not there. Second is markets need a clear runway. And Vikram, the employment data has come in. The wages have been rising by 4.4%. Now, that's not consistent with the 2% inflation that Fed is trying to control. So eventually, if you try and combine all of these parameters together, Vikram, it looks like markets are very range bound. If they fall, they can easily go back to 4,000 or below. Fear really works very well in that direction as well, right? So that's my sense. I've always believed that S&P can always even touch 3,500 again. And I think we do need some kind of the recession to purge this thing out. I don't want it, but ultimately, I think that's the eventual solution we have for this.
Spoken about how the Fed could induce this kind of recession because that's perhaps what it needs right now to control the current situation. But it seems like the economy has been resilient, and that's where this problem gets a little more complex, because how exactly does the Fed move on interest rates going ahead from here? It's going to be an interesting watch, but we hope that there isn't too much bleed in the markets because of all these fears that seem to be mounting with the kind of downgrades that are coming in. The latest one that we are talking about with Anurag, about Moody and how Moodys has downgraded certain banks. And there could be more, is the warning as well. We'll keep watching what happens in the markets, and we'll keep connecting with the experts like Anurag Singh to give us perspective on whether or not we should be worried. But for the moment, it's where we are leaving it at on this edition of India Development Debate. Thank you, Need, for joining us. Do take good care of yourselves and have a good night. Bye-bye.